Hello. Thank you. Good morning. And is anyone else freezing like I am? Because pretty darn cold. Okay. I was wearing my hoodie, but I feel a bit naked right now. Alrighty. So where are we? Over there. I wanted to introduce, I guess, a couple things. One is a novel concept on the current PBS flow, as well as a mechanism to capture potentially more or almost all of the MEV that exists. And listening to Max's presentation earlier on braid, I think there might be some points of intersection which make sense. So something to unpack over the next while here. First off, I wanted to highlight what if you could buy 32 blocks of Ethereum? And what you can't do this right now, but like what if? So it's more of a thought exercise in terms of like, how do we price 32 blocks? What are the dynamics around it? Ultimately, I want to create a bit of a boundary value condition for, what is the worst case, what's the best case, and just kind of see how that goes. Importantly, this is a pricing discussion. It's not an ideological one. Is this good? Is it bad? It's more of an economics thing. So for anyone who wants more information, there's an article on the ETH research as well as a pricing model behind this, but I'll get into it very shortly. So the first part is basically, if I could buy 32 blocks of Ethereum, it's about 6.4 minutes. And so over that time, there is a deviation between basically the current or previous state on chain versus how prices evolve within a centralized environment. So imaginably, over that 6-minute time period, you would have complete transparency, complete optionality to basically, in this case here, let's say prices on Binance rise by 5%. At that point in time, you can basically sell some assets on Binance or some portfolio of assets on Binance, and you could basically then buy them on Ethereum at the last recent price, which was some combination of up to 32 blocks ago. So this difference is what a lot of these SEX, DEX, ARBs guys do in practice. And that's kind of on a historical looking basis. What we want to do, or at least think about, is the ability to use the options or vol markets to think forward into the future. Because of course, the expectations around future volatility and future movement, that is digested into the vol markets. So in this case here, what we assume is that, what if you could short a strangle, a strangle, on, say, Deribit, for example. Now, you short that strangle, I'll get into the details a bit later, but let's say that yields you $10,000. Now, I can basically take that $10,000, I can go out and buy the next 32 blocks on Ethereum, and basically, if I lose money on my short straddle position in Deribit, I would make that money back on the blocks that I've bought. And so therefore, we create kind of like a non-arbitrage condition or non-arbitrage pricing model for this. Now, having said that, so in this case, just to recap, I would earn 10,000 in fees, and I would use that 10,000 to buy blocks. And so therefore, 10,000 divided by 32 blocks, that is the price of a block. However, there's additional upside that is not factored into this. This is just playing an options market versus a blocks market, but there's other MEV that we haven't accounted for. So in this context, this is a floor pricing, meaning that the long blocks part of the transaction, I have upside on it, in the sense that I can execute that option whenever I want. It's a bit of an American option, plus I can capture additional forms of MEV. So what we want to do is basically quantify this relationship here. So we looked at the a certain amount of liquidity. How much could we do in practice? And so it's less than 10 million, but we use 10 million as an example because ultimately you need to look at every asset that this might be possible for, or like a portfolio of assets. So we could look at like ETH, Solana, I don't know, Dogecoin, like a whole bunch of things, right? But long story short, in this example, we have 10 million ETH, a vol of 75%, rates of 4%. This can be somewhat arbitrary for this exercise. The fees in this context are really bid offer. And so, if I'm going to execute the trade on either side, what are the friction costs? What are the transaction costs? And ultimately, I need these options I need the spot to move beyond a certain threshold in order to be able to encompass the friction costs. But in this case, historically, over the last year, if we could do this from historical vols, that results in about 1.25, a little bit more percent increase in yields for validators, which is incredible. And this has nothing to do with conventional order flow. This has nothing to do with traditional MEV, although there is an intersection with MEV, but that's basically what it comes to. A whole bunch of other considerations around how much liquidity is there in the market, how much slippage is there. I'm using a vol of 75%. In this case, again, vol is a real-time instrument. We could be looking at Deribit to see how is this going up and down every seconds, minutes, or whatever it might be. Another consideration is that super short-dated vol is much higher. It's actually around 150 on ETH. And so, again, a lot of considerations here, but it's a thought experiment, but it could very soon be practical. So I want to bring this up here. And feel free to chat with me after about it. I love this stuff. We have a bunch of options traders who want to figure out how to make it work as well. I should say one of the dynamics is in the future gas markets that I and we and a few others of us are creating, is that how can we bring a new set of users into this market? How can we unify, from a macro perspective, the price of these blocks with other financial instruments? And so that's part of this exercise. Okay, so on to unified gateways. So quickly what we do, real-time pre-confirmations and gas products. So basically, I can buy an L1 pre-conf in 3 milliseconds, and in the future, we can apply to base rollups, but basically, this enables real-time settlements on Ethereum. I'll skip the ideological parts, but you can take a look. And the goal is really just reduce fragmentation, maximize utility for as many users as possible. And so on the searcher and trader side, basically we're looking to give searchers more choice around order execution and customization. For the validators, they're going to end up with more fees, more control, more choice. But ultimately, it's really to close the gaps within kind of the current proposer-builder separation, or PBS flow. So this is the current flow, where I'd posit that it's quite fragmented. Builders compete with one another, but there's a lot of uncertainty over, will their transactions be included? And for anyone who's working with some of the, let's call it some of the neutral block builders, some of the trades you would do with the neutral block builders, they're also only conditional guarantees that they might be able to offer. But let me dig into this here. So in our proposal, we have this idea of like a unified gateway. So every kind of different slot, you could have a different gateway. But each gateway is intended to capture all the deal flow, all the transaction flow, within an environment where you don't expose the trades to basically anyone that's involved in the entire marketplace or in the gateway. What have I missed? Okay. And so in this case, each proposer would delegate a single gateway for each block, and this can be done through commit boost, if anyone's familiar with that. Now, what happens in this gateway is basically marketplace for gas products. And so we can buy a mix of various types of gas products, but ultimately you'd have a mix of builders, searchers, HFT, market makers, basically anyone who can trade these gas products in and amongst one another. And what happens is that we go from an environment where you'd have, say, 4 dominant block builders to having potentially like 20 or 30 or 40 different pseudo block builders that compete with each other to structure the nature of this block. And in this dynamic, we're not leaking trade information from one person to another. What we're simply doing is commoditizing the trades that might be able to be put into the block. And so these types of trades are a mix of these. So we would have a mix of inclusion pre-confirmations. So this is where I pay some fee, and the proposer basically guarantees to include my trade in that block. It doesn't guarantee a certain state. The second one is an execution guarantee, where I say, hey, I want to put this trade through, but I want to make money on it. Or I want to put this trade through, but I want it to be successful. And so that's an execution guarantee. The other element is just the entire block itself. So if I can sell an entire block to a, let's call it a non-traditional player in that PBS flow, let's say I'm just going to say GSR for argument's sake. If I can sell an entire block to GSR, they would then try to maximize that block through their own internal order flow. But at some point, they can also decompose that block into its constituent parts. A mix of inclusion preconfirmations, a mix of execution preconfs, a mix of basically just general order flow. But in this entire process, they can't actually see the orders that are going through there. And so what I'd argue is that, again, that this it basically brings kind of more demand for blocks and more demand for the gas-based products. I'm just wary of time here, so I'm kind of speeding through. But so the way we see it is that builders have incomplete order flow, and they can't really maximize the value of the block. And so if we have a unified interface, then basically that gateway can maximize the total value of MEV within that current block. Secondly, the builders, again, they can only offer conditional guarantees. And so absolute guarantees, of course, would be worth far more. There's no secondary market or no price discovery. And so one of the questions around gas market products is, if I'm buying or selling a pre-conf, like, is the price right? Is it correct? And so in this context, you're able to have a market that builds basically a futures curve for a mix of pre-confirmations, a mix of blocks, ensuring that it's a competitive process and it's a fair or a neutral process. Just wary of time. But finally, it basically introduces this dynamic where, again, either theoretically or practically, a block which is part of a consecutive block is worth far more than just like a block that stands alone on its own. And that's worth more than a block which is just a sum of these constituent parts. It's just a mix of execution guarantees or inclusion preconfs or just general order flow. And so you kind of have this dynamic where you have more and more MEV capture as you go up this gradient. And there are some ideological conversations to be had in this regard. And so ultimately, where do validators or proposers want to be on this spectrum? Where does the industry want to be on this spectrum? But for us in the infrastructure layer, we're creating the technology, and we'd like to engage with various participants to see what is the right way to approach it. As I said, we can capture far more MEV, we can capture far more, we can maximize the utility between all the participants much better, but it does have implications for the broader community. And so there we go. You can read more about us just on our site. We have a full set of docs, API endpoints, etc. Reach out. My name's Kevin. Thank you for this today.